Even before the trade war, we already had real problems in this country. It's a problem of high price. And I'm telling you, it's no longer sustainable. You keep hearing that companies will have to raise prices with tariffs. That's wrong. What they really need to do is cut prices, or their stuff isn't going to move off the shelves. And these companies have to stop pretending they can make it all up by endlessly cutting costs. Things are just too expensive right now, and they're about to get even more expensive with the tariffs. But a lot of companies just aren't ready. They want to keep playing the same old, cutting costs, keeping gross margins up, even with sales slowing. No day goes by without signs of this. When we read a PepsiCo downgrade yesterday, and it talks about how the price of potato chips have gotten too expensive, well, you can't even laugh. The price of a 1-ounce bag of Frito-Lay chips has increased by 66% from 2020 to today, according to multiple surveys online. I think it must have hit a tipping point where people are just fed up, especially when published reports show that the chip count has dropped from 18 down to 14 or 15 per bag. So what can PepsiCo do? Well, it's been trying to sell different form factors. That apparently hasn't worked. Wrench costs out wherever it can. While they can probably find more ways to save money because they're geniuses at it, at some point, you run out of costs to cut. To me, the answer is quite obvious. Consumer product companies simply have to take the hit. They got to lower the prices. Of course, if they take the hit, then indeed the gross margins go down. No company ever wants that to happen. Once the gross margins come down, they fear their earnings will come down big. And at that point, only a sizable dividend can prevent your share price from falling through the floor. I got to tell you, guys, it is worth it. This incremental game of cuts is giving you a lower stock price anyway every day. It is time to rip the darn Band-Aid. Let me give you another. Consider the terrible numbers from the Sephora division of LVMH. The weakness came from the United States. Interestingly enough, Sephora will soon be in 1,100 Kohl's locations as a store within a store. And Kohl's is hanging on by its fingernails. Do you think Sephora can keep prices high? I think it's got to roll back some of those price increases put through over the last few years. But then critics will say, see, Sephora's maxed out, and parent company LVMH's stock will get it. I don't care. It's another one that won't cut, and it will lose for not cutting. And Sephora isn't the only one. LVMH brand that has to cut. I mean, these guys also make this expensive cognac called Hennessy. Judging by the double-digit decline in sales, there is no way that Hennessy can keep charging these high prices. The premium isn't worth it. Premiumization is over in this country. Now, I can see them coming with a new, cheaper kind of cognac, maybe stabilize some growth for a while, but it won't help their gross margins. They need to cut the price of Hennessy. Next, I thought that Lululemon stock might be able to stabilize, but I just don't know if it can. Why? Because its stuff costs too much versus the other guys. Same with RH, so Restoration Hardware. Now, their furnishings are breathtaking, but the tariffs are going to force them to raise prices, make a lot of stuff in Vietnam, probably substantially. And that's real bad because these prices are already too high. You know what they have to do? Cut price. Of course, companies have been managing inflation for years now, and I think they've done a pretty good job. Taking dribs and drabs, a little bit of pricing here and there, a couple of pennies here, maybe a couple times this year. But even late last year, we knew that the consumer was getting fed up with high prices. Now we have all the tariffs to deal with, and I don't think retail is ready for what's about to occur. I don't even know if the supermarkets are ready for about what's going to occur. The customers demand lower prices, but the government's basically forcing them to raise prices to cover the cost of the tariffs. They've got to eat it. I don't know which companies will break the gross margin buck first, but I do know this. It will happen. It will happen in 2025, and they're going to do the eating. There just aren't enough costs left for them to cut. They've trimmed most of the fat. Now what's left is flesh and bone. When these retail gross margins finally start coming down, maybe then their stocks can at last bottom. But until then, it is indeed death by 1,000 cuts. There's only one choice: merge. That's what they really have to do. When companies merge, that creates new cost-cutting opportunities, which is exactly what can prevent the margins from getting annihilated here. Otherwise, be prepared, because when potato chips are too expensive, everything's too expensive. Alex says, as always, bull market summer problem starts just for you right here on Mad Money. I'm Jim Cramer. I will see you tomorrow.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.